Willie,
Yes.
we're back.
Oh God, I
Are
have
you
to put up
excited?
with you again.
Well, look, I'm super excited that we're back. A lot of people have been asking where we've been, and a lot has been going on. Just to give our
hmm
audience a little bit of a quick background, we're building a new company that you and I believe it's going to not only bring finance back to where it should be, but it's also going to innovate at the same time, and
hmm
where they can do the things they have to do already in finance, buy a home, have a retirement account, invest in all the sorts, but do it in a way that's more all in sync, and they actually can preserve their wealth and build their wealth, which is something that's a big problem. But I don't want to say too much because I want to give it away. But we're
Wait,
back.
you're saying we're actually going to care about people?
I guess so. I guess
That's
that's something that not a lot of people really do care
it's
when they're.
it's sad that we've gotten to the point in the world where actually giving a damn is considered innovation, but here we are.
And here we are. So, as we built this company, though, we felt it would be important that, we continue this podcast because a lot of people found that it was really helpful for them to
hmm
understand more of what's going on. But the difference is we're going to focus mostly on the economy, on finance, and really providing a really more digestible, easier to understand, even a 5-year-old can understand, on the complex economic and financial issues. So, and also how it affects them, right? We all are busy, we all live our lives, we're all doing our thing. And now you're getting a bunch of, bombardment from the news, from social media, your know-it-all friends, your financial advisor, your banker, who the hell, right? But how about we just simplify this, tell them what's going on, and tell them how it affects them and what they can do about it,
I
right?
agree.
End of
Let,
the
let
day,
us
that's
be
what
your
matters.
know-it-all friends.
Yeah, I know, right? And those are the ones that are probably doing crypto and losing all their damn money. So, anyways, so I think for the first episode, back, we just explained
hmm
why we're doing this,
hmm
and I think the biggest thing right now with all the interest rates going on is housing. I think this is a
Mm.
great first topic is to talk
Well,
about
you're saying
housing.
housing is necessary? Is that
I would
is that
hope
my
so.
understanding?
I would hope so.
Oh,
So,
interesting. You'd
Willie,
figure if it were necessary, more people would be able to afford it.
yeah, I mean, it's interesting times. If you locked in, a couple of years ago at 2 to 3%, God bless you. Uh,
hmm
but there's a lot of people that are concerned about housing, whether they're new home buyers
Yeah.
or they want to refinance, or what is going to happen, right? Because it's getting ridiculous out there. So let's dive into the housing. Let's keep it simple. Let's talk a little bit more background on what all this is. And our viewers, if we lose you a little bit, hang in there because we're going to simplify it as we go. So, Willie, you want to kick it off?
Well, at the risk of sounding boring, uh, yeah. I mean, one of the things I love most about housing, aside from the hope of one day being able to afford it, uh, is indices, right? Like me, I love data. I love pretty graphs. And one thing that caught my eye, especially with all the recent news, is the what's called the Case Shiller Index of home prices. So if you're not familiar, this is actually a set of multiple indices, right? There's a national, there's a 20 city composite, 10 city composite, etc. But it's a way of tracking home prices normalized to a certain level, right? And you may have seen this in the news. The irony is that the Case Shiller Index was actually developed to study pricing trends during a housing boom, right? For those who were around in 1980s Boston, there was a housing boom that was fueled in part by speculation. You may stop us when this sounds familiar. And so the index was created by these two professors. Surprisingly, they were named Case and Shiller, one from Wellesley and one from Yale.
Ugh,
To
Sorry about Harvard guys. Every time I hear Yale, I have to do that.
do
Anyway,
you need some Alka Seltzer or some
I might need
earwax or
some.
something? Okay, well I'm
Yeah.
We'll just call it the Y place. How's that? Is that safe
Got it.
for you?
There you go.
Yeah.
Thank you.
Yeah. Well, well, the professor from the Y place is also a Nobel laureate, so he may or may not know what he's talking about. Obvious sarcasm. But anyway, this is focusing on single-family home sales. Okay, no apartments, no condos, no townhomes, detached homes only that were second sales, right? So they're not new starts. This is literally what most people who are going to buy a home are probably going to be buying, right? A detached residence. It is not a new construction. It is somewhere in the country, I hope. And, you know, the index is important because the obvious reason, you know, for the traders, this is what sets the pricing level on the Chicago exchange for real estate futures and options. So that's an obvious reason why it matters. But it is also giving you a kind of an insight onto the health of the U.S. real estate market.
Mm-hmm.
You would think that is relevant today. But here's the interesting thing that's going to probably piss off a lot of people. It's certainly food for thought, and we can discuss it. Case and Shiller expanded this index and normalized it to home prices going all the way back to 1890, right? In real terms, and this is where it matters today because everyone's complaining about housing costs, etc. In real terms, this index is reverting. Macro forces always drive it back to the 1890 level, which is terrifying when you consider that today it's well north of 200. So does this mean that we have a pricing correction due for housing? Obviously, you know my position on it, but what are your thoughts?
You know, I'm a person that loves to look at history, right?
Mhm.
And I've always said, and many say this, right? History may not repeat, but it rhymes.
Yep.
And the data shows it. Data does not lie. And I think there will absolutely be a correction. And for our listeners, you know, all these indices, you probably heard it somewhere, whether it's from a friend or you've seen it on TV or you've seen it on social media or whatnot. What all these indices just do is, when compiled, is just giving us indicators of where things are headed. And right now, a lot of these indices are showing there will be a correction. And you know, what that means is, you know, just real quick, you see all these new homes being built. I know a lot of people are noticing that. You know, you drive around and there's all these homes being built, and a lot of that is,
and they're going up fast,
way too fast. I'm telling you right now. I look at these homes and I'm going, you know what? They're
it's
probably
like construction technology evolves or something. Is that what we're saying?
Yeah, I hope it's that, or if they're building that fast and there's a bunch of cracks, I'm gonna be really mad. But you know, it's incredible with all these homes how fast are being built. And I think a lot has been driven by institutional investors who are buying a lot of this, which concerned me, right? And I think, you know, that hasn't been a major part of the housing market to recently. Correct me if I'm wrong. Right? In the past, it's been consumer driven. It's been, you know, the families and individuals from buying homes in the retail market.
Yep.
But now we're seeing institutional involvement coming in, right? And they're forcing a whole lot of builds happening, right? So, you know, the imbalance between what you said, those second homes, right? Like the homes on the second sale, but now you've seen a lot of the first sale homes, the housing starts. So this is going to have to be corrected, right? Because people, even though there's, you know, in the recent stats, people are still buying homes, which concern me because based on housing cost and with the mortgage rates, I think there's going to be a major correction that's going to happen because of all this. There's, it doesn't make sense, right? The numbers don't add up, and the Shiller Index does not lie, and it's a bit out of whack. And not to mention there's other factors involved, right? You know, interest rates in general, the debt's at all-time high. I mean, credit card debts have hit over $1 trillion.
Yeah, over $1 trillion.
Right. Savings accounts are getting depleted. The average wealth of each consumer is going down. Even when you see a strong job market right now and you're seeing increases in wages, it still does not address the cost of housing, the interest rates, and inflation.
Right.
Oh, sorry for the long answer, but for our viewers, I went a little bit in the rabbit hole there. But long story short, what you're seeing is fact, right? So, I always say it doesn't take an Einstein to figure out where things are headed, right? What you see is what you get. You're seeing housing prices going up. You're seeing so many homes being built, but it doesn't make sense on why, because there's a lot of people, especially the average Joes and middle class, are not really buying much, but you see institutional investors buying a bunch and just sitting there. And you're seeing inflation going out, going crazy. But even if inflation is, starting to grow normally, the cost of goods are going up, right? Everyone is struggling with the cost of goods, right? When you go to the grocery store or whatnot and everything, people are tapping their savings, credit card debts go all-time high. This is all going to be corrected very soon because there's only so much, the consumer can handle. And, we're going to see a historical correction because of some of these factors that have never been experienced before.
Yeah, well, I mean, you bring up some good points. Obviously, the massive infusion of money during the pandemic probably did not help matters. We're seeing now inflation is not exactly transitory, but it's a strange coincidence or confluence of events, because you mentioned consumer credit debt is over $1 trillion, which is horrifying when you consider the interest rates that are going to be charged and that are being charged. But here's the thing, we mentioned before that the Fed response to inflation was a little toothless. Let's still a little 25 bips nibble here and there. Here's what I'm saying. We have a deadlock in housing, right? Nobody that has it wants to sell, because why would I trade a 3% rate for a 7.5% or 8% or 10%, wherever it is that we end up during this cycle? Why would I trade that for something I can't afford? Or why would I trade the house that I have for a mortgage payment that I can't afford that is going to necessitate a smaller house? Right? That's not rational thinking, and it's certainly not in tune with what most people want in the American dream, right?
Right.
But that also means that if you're looking to buy, no one's looking to sell, right? So if you look at the home sales year over year increase, it's been flat for a while. So basically, unless you're doing a cash for cash transaction, I don't know how many of those happen, but you're not going to be in a good place. But here's what I'm seeing is that in addition to that, you do have wage increases, which are driving inflation, right? People are still behind or feeling behind, but we're talking on a macro level, right? So you have the Fed trying to raise rates to undo inflation, but then you have inflationary wage pressures, people getting paid more, because that seems to be the only way that you can attract and retain workers. So you have these two forces that are fighting against each other. My question is, which is going to give first, right?
Right.
We have culturally, we have no concept of what a good interest rate environment actually is. Like if you look at historically, we're about at the 70-year average for the federal funds effective rate. There were some spikes thanks to Volcker taking some extreme measures, but we've had low rates for so long. I think a lot of us personally and business-wise have kind of gotten addicted to this easy money, Bernanke-led quantitative easing environment. I don't think we know how to survive with rates being at what should be an average, historically reasonable level. And I only see one way for this to go, right? We are going to have a recession, because that's just how the business cycle works. Past Powell, I'm not involved in rate decisions. Powell is going to have to keep raising rates because, you know, the CPI report for July 2023 just dropped, and it's accelerating again. So what's going to happen first? Are we going to have a recession where you have to cut rates, and then if you cut rates, you risk inflation rebounding again? Or are we going to get the economy choked to the point where a recession is inevitable? I think it's going to be the latter because it has to be. Right.
Right. Right. And again, you know, it's just all this is so unprecedented, right? Because we have COVID, and then, you know, and when COVID hit, you know, we were still in that Bernanke era, right? Of easy cash, you know, and all those sorts. And then, you know, the institutional aspect of it, I'm gonna keep emphasizing institutional aspect. But you already identified those two key points that are just already factored in general. That's just basic economics, right? And for the housing industry or the housing market. Now you have these institutional players coming in, and they're starting to hurt, right? You're starting to see them starting to hurt, and they're starting to slow down their purchases because they owe a lot of debt, right? I mean, you look at all these major players. I mean, they've been, you know, whether it's for their REITs, whether it's just for their investments in general, they're holding a lot of these homes that they can't get rid of now, and they paid a lot of fortune for it. So that is, you know, to me, another key factor that can really make this blow up in a poor way. And, you know, if you look historically, economically, when we don't know what's going on and something's never happened before and things don't make sense, you know, it tends to blow up. Like look at 2008, right? People weren't understanding what these mortgage-backed securities were, and why were you know, why is it like a trickle effect, right? Why were they swapping for poor this, you know, and it's just doesn't make sense. And you have someone that is making, you know, $80,000 a year that can buy $1 million home, you know, so it just didn't add up. You know, the supply and demand was way off. So we're seeing aspects of that, but in the opposite way. And I think it's gonna really implode just as bad, or maybe even worse.
So you're not a fan of the 1% down mortgages that are being offered
for 40
now?
years? Yeah.
Well, I think there was like one of them was a 40-year, and then the other one was a 1% down. I
don't know.
Zillow's offering 1% and 40 years. That would be terrifying.
It is. Zillow has offered a 1% down 40-year mortgage, which pisses me off beyond belief. And, you know, the lack of financial literacy that a lot of folks have, they're taken advantage of. And I really hate seeing that. I know we both do. And that's only going to contribute to this stew of crap that's being cooked right now in this economy. And let's not mention China as well, right? China has poured so much money and government stimulus into their housing market. And now they're seeing unaffordability. They're seeing commercial and residential real estate being empty. And it's all disoriented. So that's going to have a trickle effect globally as well. So that's another fourth factor that is playing into this, right? So, you know, this is just really concerning. And, you know, housing is the core of the economy. And, you know, it's just scary. And I think a lot of our viewers, what they're going to be asking right now is going, okay, this is a lot, right? There's a lot of fear that we're putting out there. But I think that if our viewers do a couple of things for their sake, I think they can, you know, weather the storm and come out better. So with that, I don't know if anything
absolutely
else
not financial advice, though.
Yes, to be clear, it's
do
just
your own research.
Yeah, it's just
our lawyers are happy.
Yeah, it's just our knowledge, and we're sharing our knowledge, and you can take it or not. But we're hoping that, you know, we're taking all this and simplifying it now. Unless you have anything to add, Willie, that's kind of provide knowledge on what we would do in this situation. You know, would we buy a home or not? You know, would we rent or not? Would we like what would we be doing if we were someone that is looking to buy a home or not?
Well, I mean, the easy answer to that is you can do what Warren Buffett's doing, and whatever your down payment is for your house, you can roll into treasuries, right? And it's I certainly wouldn't buy a house right now. And you look at the price of everything is going up, right? Which is not a surprise to anyone who's been alive the past 3 years. But we now have, what is the average car note is almost $1,000 a month.
Yeah, or just
like
a
the
little bit
average
over.
price of a new car is 40,000. Yeah, electric vehicles are super expensive, but there's not enough of them to make that jump. I think the median home price is now almost $400K,
Right.
something like that. We're obviously overheated, and I think some of this probably has to do with the fact that people are terrible for many ways, but they're terrible at estimating how a home is going to appreciate over time, right? Most people think that the house is going to go 2% annual appreciation. In real terms, realistically it's 0.7% ish, right? You are told to get into real estate because it's the fantastic investment, etc., and it certainly is, and there's certainly many tax benefits that go along with it. But I think we're at a point where I think we're seeing a lot of the same fear of pre-08 being pushed out by the media, by so-called experts. House prices are insane. They're only going up. This is not 2008. A crash is not coming. I don't necessarily believe that. Do I think it's a terrible?
Let's simplify this real quick.
Yeah.
So real quick, Will.
Right,
so I get duped by a realtor, right? And I am paying. I have great credit. So let's say I got a 6.5% interest rate, right, for my mortgage, but the house is $1 million, right?
Mm-hmm.
And I buy it right now in this current market that's hot, and the price goes up for a little bit. But what happens when we hit a recession and the market, as we predict, is going to go haywire? What happens to that? Does the value stay at $1 million? Does my mortgage rate stay 6.5%? And what happens from that moment?
Well, it's funny you mentioned that. I did see a tweet about somebody asking if the value of their home goes down, can they get a refund?
Right.
God, I wish that were true.
Right.
No, it's Econ 101, right? If you go into a house right now and it's overvalued, and you get a mortgage that is what it is, and you think you got a great deal, when the economy turns, that home is not going to be worth as much. You're going to be paying more than the asset value is. Now there's arguments to be made, like, well, okay, if you're buying a house for the long term, if you're buying a house to live in, like I have a 30-year mortgage because I want to live here for 30 years. I want to die in this house.
Mm-hmm.
Then it doesn't really matter, right? Because recessions aren't going to last 30 plus years, I hope. Even the Great Depression did not last 30 years. So if that's your time horizon, if you have a long-term view, it shouldn't matter that much. Rates are going to come back down at some point. You're going to be able to refinance at some point. Maybe not in the best terms, but if you buy now, and you better hold on, right? Because there's absolutely no guarantee that your house price is going to go up in the next few years, right? You are going to be stuck with that payment, until such a time as rates go down or you get foreclosed on, whichever happens first.
Yeah, because yes, what you're saying is, I go on a 6.5%. That's locked in, right? That monthly payment is locked in, right? That's the agreement on that $1 million house, and then that million goes down. Let's say it continues to go down and it hits 750,000. I am paying $1 million mortgage locked in at 6.5% on a house that's going from $1 million to 850,000. Now you can refinance, but you still lost value in that home.
Sure.
And that's the important thing that our viewers have to listen to, especially when you're, when you're younger, you're a new family, and you're looking to buy a home. What we're saying is patience pays off, right?
Yeah.
It's okay to rent a little bit, right? It's, yeah, rents are a little bit high.
Hmm.
And would you recommend, or let's say, would you rent right now, or would you how would you go? Because people are saying rents are costing more than the mortgage, right? My view is, yeah, I'd rather pay more for 2 years on the rent than get locked in on a mortgage and lose $250,000 or even
Sure.
$100,000 on the
Sure.
home value, right? I mean, that's how I see it.
Right. I mean, well, my unpopular opinion is if you're young and you're starting out and you're saving for a house, you know what? Yeah, renting is probably a good idea. If you can live with your parents for free, that's an even better idea. Uh,
Yeah,
but if that's obviously that's not an option for everyone, and not everyone can telework and so on. But you may not have a choice but to rent right now.
right.
And that's the thing you have to remember. It's the duration of your exposure to a contractual obligation, right? If you get a mortgage, you are on the hook for 30 years until you pay it off, get foreclosed on, or whatever. Renting is a lot easier.
Yeah. Oh,
Like,
and
yeah,
that's the key thing you just said right there, right?
yes,
So if you do want to sell that home eventually, let's say 5, 10 years from now, and the value did go down by 100, 200, 300,000, you lost
yep,
100, 200, $300,000
yeah,
on that home because it went down. In addition, you just paid a high interest rate per month as well.
yeah,
So our viewers have to remember that basic math right there
yeah.
on that.
And no, and that's a good point. I mean, I was told actually when I was younger, don't rent. You're throwing your money away. You're not building equity. Okay, technically that is correct. If I pay you $1,000 in rent, which these days is probably 1/3 of the rent of a studio apartment,
Yeah, you're
uh,
practically paying for a tent on the street. Yeah.
right? $1,000 a month gets me a bathroom. But if I pay you $1,000 a month in rent, yeah, technically that's not going toward building equity in a house. But as you said, if the home price drops 200,000, well, I've now lost 200,000 of potential equity that I could have had. Am I going to pay you $200,000 in rent? Probably not. And so it again has to go back to this time horizon, right? If you don't know what the next 5 years are going to hold because you started a new job or you moved to a new city, whatever, yeah, it'd be great to have a place to call your own, but renting is probably going to be your only intelligent option, right? Now, if you're mid-career, you got a spouse and a couple kids, dogs and the fence, okay, fine. Maybe in that instance, buying a home is going to be more logical, and you certainly have more tax advantages in terms of interest write-off with buying than you do with renting. But right now, I think the economy has made the choice for you.
Right. So, end of the day, when it comes to housing, because again, a question we get a lot
Hmm.
is that overall it's situational based
Yeah.
on who you are, but we do see a recession. We do see the housing market going to hit a bubble, right? And we have to remember, Canada is about to hit a bubble. China
Mhm.
is having issues. We're having our own issues, and when all those things start to pop, it's going to really drag the overall market down.
Yeah.
And if it was you and I right now looking for a home, it would be pause. It's okay to
Mhm.
rent, or let's say live with your parents, right? Depending on who you are, and take whatever money you saved and make sure you put that in a high earning savings account or a mix of that and a good conservative investment, ETF, index fund, or whatnot, because
Sure.
that's going to cover your spread with the rent pretty much, right? So it's just basics of finance. And so that's a good summary, I think, for our viewers, right? It's situational. Do your own math, but just know that there will be a bubble, right? In our prediction, and be patient. I think patience pays dividends to a lot of people,
No
and because
pun
the last thing
intended.
you want to do is, and the last thing you want to do is 3 or 4 years down the road look back and go, you know I almost swore. I'm sorry. 3,
Don't
4
get
years
us
down.
demonetized already. It's only the first episode that we're back.
Yeah, let's go 3, 4 years down the road, and you look back going, oh, dang it, I should have waited, because I would have been better off now, paying a low interest rate and a lower cost home.
Sure.
So yeah, anything else you have, Willie, to add
the
to our
real
viewers?
question is, who's going to play Michael Burry in The Big Short 2? And who's going to play Chair Powell?
Ooh, that's a good question.
Because we're kind of getting the script for it written right now, in real time.
Yeah, you're seeing it, and it just amazes me, and it amazes you, how history continues to rhyme and how blinded our policymakers and our leaders are, how they're getting away with it. It just fascinates me,
Well, sure.
with that. And I remember, just yesterday I was talking to a friend at Morgan Stanley, and she had her blinders on. She was saying, buy these residential products, and she's pretty much describing a glorified MBS, right, with 8% return. And I'm going, okay, but I can get a Vanguard ETF at 18% right now. And she's saying, well, people, need to buy homes, and it's a forever home. And, I think a lot of our viewers will understand sometimes in life, nothing's forever, right? You may think so at the moment, but you got to prepare as if you may sell it in 10, 15 years, because you don't know if your job's locked in forever. You don't know if you're going to be married forever. I hope so for all of you. Or, what your situation is going to be. So, we always say plan for the worst. And when you do that, you always end up better. So hopefully that line can help people, that piece of what we just said resonates with people, and, just plan accordingly.
Yeah. Always expect the worst. The joke that the optimist thinks that the glass is half full, the pessimist thinks that the glass is half empty, the engineer thinks that the glass is twice as big as it needs to be. But I've found in life, if you don't, as long as you continue planning for the worst, A, you'll never be disappointed, and B, you'll never be caught off guard, which in these times is worth more than gold.
Right. And this doesn't mean you'll never accomplish your dreams. You will. It's just you'll be much better off, and patience always wins. Yes. All right. Well, thank you everyone for listening. We'll be back next week. And I'm sure we'll have plenty of news to cover and to simplify for you.
If you have any questions, have opinions.
Oh, plenty of opinions. And if you have any questions, feel free to email us, visit our website, fill a form, or DM us or whatnot, tweet at us. We'll do our best to respond to a lot of them. Take care.
Thanks. Bye-bye.